Hello, I'm Haider Malik, host of the Mehmi Financial Group podcast. Today's topic is Quebec infrastructure renaissance, financing heavy equipment in Montreal's expansion. Major projects, from metro extensions to highway overpasses and clean energy facilities, are transforming the regional landscape. To win and deliver these contracts, you need access to tunnel boring machines, high capacity cranes, drilling rigs, and specialized earth movers. Outright purchases can strain your balance sheet, so let's explore tailored financing strategies for Montreal's growth wave. First, project backed term loans. Quebec based lenders and national banks now offer amortizations tied to your contract draw schedules. Instead of a fixed 7-year term, you align repayments with progress payments and holdback releases on public works projects. Present your project agreements, detailed billing timetables, and release date projections. This transparency often unlocks advance rates up to 90% of equipment cost, with spreads 0.5 to 1.0% below standard term loans. Next, consider equipment leasing, finance, and operating options. For core assets, tower cranes, or permanent pumping stations, a finance lease secures machinery for 5 to 7 years with a nominal end of term buyout. Lease payments remain predictable and match project cash flows while preserving your working capital. For short lived or specialty gear, self propelled drilling rigs or shoring systems, an operating lease or rental lets you return equipment at job completion, avoiding residual value risk and large buyouts. Sale leasebacks can inject immediate liquidity if you already own late model fleet units. Sell your excavators or aerial lifts to a financing partner and lease them back immediately under operating agreements. The lump sum proceeds fund deposits on new high value machinery needed for metro or bridge work, while you continue operating your existing fleet without interruption. Detailed maintenance records maximize your resale value and secure more favorable lease terms. A revolving line of credit secured by accounts receivable or equipment appraisals provides on-demand working capital. Construction firms in Montreal often face billing delays or municipal holdbacks. With a credit facility, you can draw up to 80% of outstanding invoices or 65% of appraised equipment value to cover mobilization, labor, and materials. Interest accrues only on the drawn balance, and you can repay and redraw as payments arrive. Invoice factoring accelerates cash flow when payment cycles stretch 30 to 90 days. Partner with a factor experienced in Quebec's specific retainage rules. They'll advance 80 to 95% of each invoice within 24 to 48 hours and handle collections. Non-recourse factoring adds a small fee, often 1 to 2%, but protects you if a client defaults or disputes payment. Government and agency programs can lower your cost of capital. The Canada Small Business Financing Program supports equipment loans up to $1 million with shared lender risk, often translating into rates 0.5 to 1% below market. Quebec's Fond de Développement Économique offers loan guarantees and interest subsidies for machines used in public works and clean energy projects. Align your financing so that loan disbursements occur just after grant or guarantee approvals, avoiding upfront cash demands. Vendor financing and OEM partnerships add another layer of affordability. Manufacturers like Liebherr, Sany, and Terex often back major project wins with promotional terms, deferred payments, stepped leases, or bundled maintenance packages. Leverage your project award letters to negotiate exclusive rates directly with dealers, then compare those offers against bank and credit union proposals. Before you commit, run a full cost comparison. Include interest, lease fees, residual value risk, maintenance costs, tax depreciation benefits, and any available rebates or subsidies. Model cash flows under scenarios such as permit delays, labor strikes, or materials price volatility. Stress test each financing structure to ensure covenant compliance and resilience throughout project life cycles. To implement this strategy, follow 3 steps. Assemble your financial package. Year-to-date statements, project contracts, equipment inventories, and maintenance logs. Then engage a Quebec-focused finance advisor or broker who can introduce you to multiple lenders and factors. Finally, Compare proposals on true cost of capital in alignment with your project draw schedule. By matching your financing tools to Montreal's infrastructure renaissance, you'll preserve working capital, bid more competitively, and deliver projects on time and on budget. I'm Haider Malik. Thanks for listening.